following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
I'm Tom Schneider, CMT with NinjaTrader, and on Traders Workshop, we like to bring in our NinjaTrader ecosystem partners. Today is no different, but it is a little different because it's a first-time guest on NinjaTrader Live. So I'd like you to welcome Dean Rogers, who is a senior analyst for Kase & Company, to Traders Workshop. How you doing, Dean?
Hey, doing real well, Tom. Thank you very much. I appreciate you guys. Appreciate y'all having me on. It's always a great opportunity to talk markets with everybody.
Oh, yeah, it's our pleasure, and thank you for coming on. Dean and I go a little bit of ways back, right? A couple of previous roles for me, but the great thing is Dean has been doing the same excellent work that he's been doing for as long as I've known you.
Yeah, I've been with Kase & Company with Miss Kase for 24 years now.
Wow.
So yeah, I'm one of the. It seems like I'm one of the rare few that has been in the same position for this long. But yeah, it's good work and I enjoy it, and it's a really good place to be.
I was introduced to your work and Cynthia's work when I was at CQG. Another primarily charting platform from years back, and just fascinated with the the kind of the takeaways. And it was a different time too, right? It was electronic trading was still relatively new. 23/7 or 23/5, whatever you want to call it, was still relatively new. And so I think the innovations that you guys were doing really reflected kind of what was necessary for trading, where it's heavy during the day and then it kind of tails off a little bit. And adjusting to those dynamics with the case bars was really interesting. I might be stealing the show a little bit, or we might be going in a different direction, because I know you're on the ecosystem.
Yeah, we are definitely on the ecosystem, and we've got our trading indicators on there. We've had them on since we were one of the earlier groups to get on as a third-party vendor onto NinjaTrader and into the ecosystem. And so yeah, it's been great, and it's one of definitely my favorite platforms to develop on. So my background's in computer science, computer programming, and so being able to work in C# and do all that kind of stuff on the NinjaTrader platform and the ecosystem, it makes it a lot. It's fun. It's a good environment to develop in. And we've got our trading indicators on there. So we have our Kase StatWare trading indicators and our Kase X trading indicators on there. Plus, we have a few custom bar types that we've created, X range bars. Right now, I have up on one of these charts a range bar that I use, that I developed in house, called DR range bars. And then we also have the Kase bars on there. Available for people to look at. So all these different types of bars, trading indicators, and all that good stuff on the NinjaTrader ecosystem.
That's great. Now you've got natural gas up here.
Yeah.
And it looks like you've got about, from a conventional standpoint, you've got about a little over 2 weeks worth of data.
Yeah.
And I say conventional because we're used to looking at 5-minute charts, 10-minute charts, daily charts. But I know that might not be the way you look at things with your different bars. Maybe we could zoom in a little bit to,
absolutely,
the last few days. And if you could just, there's a lot here. So I'm wondering what we can focus on that people can really take away from what the work you're doing.
Absolutely. No, definitely. Well, as far as the bar type that I'm using, so we are big believers in range type bars. Whether they're traditional range bars, Kage, whatever it might be. We have our Kase bars. These are the DR range bars. We have the X range bars. But we like the range bar type bars because they smooth the distribution of volatility. That really helps your indicators be much more sensitive and reactive to large breakout moves. So if you think about it, when you're looking at something like, let's say, a 5-minute chart, and you're looking at an overnight session, or you're looking at a period of time in the day where the market gets stale, and you're just kind of going along, and you're not seeing a lot of action, right? You're not seeing a lot of movement. That kind of lulls your indicators to sleep a little bit.
Mm-hmm.
But then you get a big breakout move, and you might have let's say on natural gas, if we had a 5-cent move in 5 minutes, that would be a pretty gigantic bar, right? Whereas if you're looking at a range bar, some type of range bar, let's say you're looking at a 1-cent range bar, then you're basically looking at something that's going to break that into 5 different bars, right? So your indicators are going to be able to react to that information much more quickly as they, so basically that lull of time where the market wasn't doing anything, that all gets compressed into 1 or 2 bars instead of, let's say, a series of 10 bars, right? Or 50 minutes or whatever it might be. And then when you get that breakout move, rather than just being a period of time, it'll basically break that out into 5 different bars, if you're looking at a 1-cent bar, and your indicators are able to react to that information much more quickly. So oftentimes I actually, the only time bars I look at really anymore personally are daily, weekly, and monthly charts when I'm doing analysis. If I'm looking at intraday, I'm generally looking at range type bars. And so, yeah,
That's
so
that's
that's
that's great. So, just to be clear, for those who are new to trading, and range bars in this case, the bars are defined by a certain range amount, not by time, right? So it's not a
exactly
range that we're thinking of, okay, from this time to that time over a regular chart. This is actually, I mean, you can look at it here and see it on the chart. The range of the bar, those bars are essentially the same height throughout the entire chart because that's how they're defined.
exactly
And so the timeline gets compressed or stretched, like Dean said, based on how quick or not quick a move might be. And this is what I found, interesting back 24 years ago, let's say, Dean, when you and I I started CQG when you started with Cynthia,
yeah,
is that idea that, boy, overnight there's not much movement, there's not much
right,
activity,
right.
but now you've
Right. No,
compressed that.
exactly. Especially back in those early days, it was definitely, the overnight session, you really didn't have much going on. It's a little more now,
Sure.
but yeah, and it definitely is something. I mean, this is something in Miss Case's book, Trading with the Odds, that she published back in, I think it was 95, maybe right around that time. She called them universal bars. We later changed the name to Case bars.
Mm-hmm.
But yeah, it was kind of the conceptualization, and as far as I know, kind of an early one where you were looking at using price as your bar delimiter rather than time.
Right.
um
Right.
and yeah, I mean, it's one of those things where I think, whether you're using the case indicators or not, if you're using any indicator, moving averages, simple RSI, MACD, stochastic, anything like that, Bollinger Bands, there has been I mean, everything that I've ever looked at using these range type bars, it in my estimation, I mean, and this is, not quantitative, it's more empirical evidence, but it improves your signals. And to me, it's just something that, it makes looking at charts a lot easier. Patterns show up better. When I talk about patterns, if you're looking for, from a technical analysis standpoint. So yeah, Tom, like you, I'm a CMT. So I think in the world of everything, to me, is technical, right? And so if you're looking at patterns like flags or head and shoulders or pennants, double tops, double bottoms, those kind of things, a lot of those patterns show up a lot easier when you're looking at range type bars as well.
Well,
So yeah,
you take out the time gaps that you might otherwise see on an
exactly.
intraday chart. You don't see them so much in daily, right? Because generally there is trading every day
Right,
in
right.
most
Well,
markets. But
Yeah, exactly. And one of the things that I do with range bars, with the range bars that we build, so the X range bars, the Case bars, and these DR range bars that we have on NinjaTrader, we don't put any fake data in. We don't put any fake ticks in.
Okay.
So we will see like gaps. So, if the market gaps up
Oh, sure.
suddenly, what I mean
Right.
by gap is, if we're trading at, $5 and all of a sudden the market jumps and it's at 550, you're going to have a 50-cent gap show up on your chart, right? And some bars will fill that in. Some bar types will fill that in with fake data or what we call ghost data. We don't do that. We basically will show that gap. And the reason we do that again is from a technical analysis standpoint. We want to see those gaps because those sometimes will give us a clue as to what's going on, whether we're getting a breakaway gap. So let's say the market's been going down for a long time and then all of a sudden it gaps up. Some people will call that like a breakaway gap. Or you're
Mhm.
having a market that goes down for a long time and then it gaps lower and then all of a sudden it turns around and gaps up again. You have basically an exhaustion gap with a breakaway. Those are clues to us, from a technical standpoint that are telling us a reversal is taking place. There's all kinds of different gaps, right? So we want to see that information. So with our bars, none of the bars use any kind of fake data. We're also usually using either true range,
Mhm.
um, which true range for again for you know uh, new traders or new listeners or whatever it might be. True range is basically the maximum distance. The way that I like to explain it is it's the maximum distance of trading between two bars. It's basically a formula, the high minus the high, the greatest of the high minus the low, the high minus the previous close, or the low minus the previous close, whichever is the
Right.
greatest of those three, that's your true range. And it basically is something that, again, is volatility related. That way, you're basically looking at when you're looking at true range on the chart, you're looking at a measure of volatility over time.
Right. Right. Speaking of gaps, we saw one today in Nat Gas.
Yeah, a little
And
gap up.
and understanding your range bars will reflect a gap, right? Because
Yeah,
if your range is, let's just pretend it's $1 and it
yeah,
gaps up $5,
yeah,
it's not within that range, right? So you have to show the gap. I think the
right,
fake data or the ghost data is when you have something based on time, you don't fill in part of the bar where it actually traded, right? You fill in the
right.
range of the bar, which is what you were talking about with that ghost data. Um,
Exactly.
and Friday could have been an example, right? At the end of the day, when we
Mhm.
had those big moves, I'm sure there was gaps of volume, right? If we think
Right.
about volume, so it's kind of the same thing. But this
Yeah.
gap on natural gas was a true gap.
Yeah, exactly. So it was kind of a breakaway gap. And, natural gas is something that, I know we're here to talk a little bit more about, the indicators and that kind of stuff. But, we cover Kase and Company, we specialize in covering the energy market. So we look at natural gas, crude oil, uh, Jim, they were just talking about ULSD, heating oil
Mhm,
or
mhm.
diesel, the gasoline markets. We also cover all the metals markets, and we do technical analysis and put out reports on those every week. So one of the things that I was looking at over the weekend, before I put my report out on Sunday, was natural gas. I mean, 250 has always traditionally been a very strong either support or resistance level. Um, and recently we've had a big run up in natural gas. It came down, hit the 252 level, which was the 62% retracement of the move up from the July contract low.
Right.
uh, Pretty big target and technical target. So I was thinking, okay, hey, look, this is an area where we could see this market move up a little bit, kind of due for a correction anyway, or a push back up to test resistance. And then we get the gap up today. So that's kind of that breakaway gap that we were just talking about. So maybe we were looking at some sort of reversal or at least period of consolidation in natural gas now. So, and one of the things that we can look at here too with our trading indicators is so the chart that we're looking at right now is a 30-point chart, which is basically 30 points on natural gas is going to be 3 cents. So that's pretty big, but that's kind of my longest or highest time frame, or bar length. I shouldn't say time frame, right? Bar
Right.
length that we look
Mhm.
at. And so we have what I have on here right now is the Case Statware indicators. And I've got basically 5 different indicators on here. The first is what we call keys, or the Kase entry system. That's these color-coded dots and the L's and the S's. L's are long, S are short trades, or permission for short trades or long trades. The color-coded dots kind of give us the underlying strength of either bullish or bearish trend, not necessarily trend, but direction.
Mm-hmm.
And then we have our Case PO indicator, which is stands for Case Peak Oscillator. It's a first derivative trend indicator or momentum indicator, momentum oscillator. It's very similar to something like the stochastic.
Mm-hmm.
So we're looking at rate of change of price over time. And so we can look for signals like divergence, overbought, oversold conditions, those kind of things with the Case PO. And then we have a second derivative indicator. So basically it's the Case Peak Oscillator less a moving average of itself, which is very much like the MACD, the MACD.
Right. Yep.
Right. And that's what we call the KCD. So kind of the same name, KCD, like MACD, right?
Right.
So
Right.
these are both of our momentum oscillators. And we use those primarily for exits, but you can use them to look at trend strength or direction as well, like you would with, RSI, stochastic, MACD, or any of those other types of momentum oscillators. And then we also look at, and just speaking of those, we also draw in our signals. So here we see like these red trend lines are basically showing us as price was rising, the momentum on the KCD indicator was falling or becoming less positive. So
Okay.
basically that's going to be a momentum divergence. Generally speaking, those are, in our opinion, and from the studies that we've done, they're very good exit signals. They're not the best entry signals,
Mm-hmm.
because they don't always result in a large directional change. It could just be a correction. It's not necessarily a reversal, but it's going to be something that would tell us if we were long going into this move up and we get this bearish divergence on the KCD, it's telling us we should probably take some profit out of that trade if we want to leg out, or at least tighten up our stops so that if it does turn, we get stopped out a lot sooner.
Right. So divergence is the case just in general, where price and maybe a momentum oscillator or
Mm-hmm.
some other indicator is not following the price. It's showing kind of the opposite trend in whatever it's measuring, right? And so
Right.
that's why it's not one for one, and you can't say, well, this is divergence, so we have to short. It just might mean that, okay, momentum's losing steam here. It's more susceptible to downward forces or news that might move the market.
Exactly. I mean, the way that I try to explain it is it's kind of, and it works for bearish divergence when prices are rising, but it's kind of like throwing a ball in the air, right? You
Right.
throw a ball like you throw a football or a baseball, it's traveling with a certain rate of, or speed or velocity or whatever it might be, right? So momentum. And then as it gets higher and higher and higher, of course, we got gravity and everything else. But as momentum declines, it's eventually going to come back down, right? So it's the same kind of thing. As prices are rising and the momentum on the KCD oscillator is declining, it's telling us that price movement, that move up, is it's basically losing conviction or losing strength.
Mm-hmm.
And when we can see that divergence gets drawn in, and usually that divergence is going to be 1 or 2 bars after the peak in price, because we need a peak in price and a peak in momentum that match up within our algorithm within 2 bars of one another, to tell us that there's a confirmed divergence, right? So we can see that it's a confirmed signal. And at that point, we're going to go ahead and take our profit or tighten up our stops, which that leads me to the last indicator, or one of the last indicators. These little color code, or these little blue dots that are above and below, these are our trailing stops. We call them the Case Dev stops. They're based upon standard deviations of the average true range.
Okay.
So we're looking at basically, we talked about true range a little bit earlier. It's a measure of volatility. So we're looking at the average true range over 30 bars. And then we're taking standard deviations of that. So early adopters would do multiples of average true range, 1, 2, 3 multiples of average true range. We actually, or in this case, wanted it to be more statistically significant. So we looked at originally 1, 2, and 3 standard deviations, so that you can look at the statistical significance of that reversal, right?
Right.
Rather than just being a multiple. That way, as volatility increases, your stops will widen. As volatility decreases, your stops will narrow and become tighter.
So
Later we moved it. Go ahead. I'm sorry.
So Dean, really quick, we like the
Yeah.
average true range. We look at it in terms of possibility, right? Where this market could go.
Absolutely.
If we're trading near the top, we measure it from the bottom. If we're trading near the bottom, we measure it from the top. And it looks like that's just been automated on your screen, right?
Yeah, exactly. That's exactly right. So, average true range is something that I use everywhere.
Yeah.
I use it all over the place. So it's one of my favorite measures.
Jim will be happy to hear that, because
yeah, good.
yeah,
No,
I'm not sure he's
absolutely.
sold on it like I am, but
True range
he'll
is something that, yeah, I mean,
he'll take
it's
your opinion.
something I use it in, like, all of my forecasting techniques and everything else. It's good stuff. But the other point that I was going to make about the stops is, when you look at the markets, you always have a right-hand skew in volatility, because the market is, bound on the left side by zero, right? Can't go, prices theoretically can't go below zero. We did see that in crude a couple of years ago, but which was a wild day.
Never say
But
never. Yeah.
never say never. Yeah, we always talked about it. It's bound by zero, but yeah. But a lot of things are bound by zero, right?
Yep.
So we don't necessarily see it move below zero, but then on the right side, it's infinitely bound on the upside. So you basically have this inherent right-hand skew. So you kind of have this tail, right? So to adjust for that, we basically use 2.2, and 3.6 standard deviation. So we're basically correcting for skew, right-hand skew.
Right.
So, and that's a minor point, I know that, but it's just something that, again, it kind of shows the attention to detail with what we're looking at in these indicators. The last indicator that I have, it's a newer indicator that we created, and it's called Kase trend. And again, it uses standard deviations of true range. It's basically the same as the dev stops, but what I'm looking at is I'm just looking at a 3 standard deviation move here. And it's basically, whenever we close above or below that, it's kind of giving us a directional trend indicator. So it's something that I use a lot of times on longer bar lengths as a filter to kind of give me permission to say, hey, the market right now, at least on this bar length, is permission short. So I can be a little bit more aggressive with my short trades, or I can be a little more aggressive with my long trades, or I'm not going to take a long trade right now because the market's permission short or filtered short by this trend indicator.
Right.
So, that's one of the challenges with, most trading indicators, especially trend following or swing trading type systems like Statware, is periods of consolidation. I think a lot of people forget that there's 3 directions to the market, right? Up, down,
Right.
and neutral.
Yeah.
And when you get into those neutral states, a lot of trend following systems, will trigger or try to trigger trades, but then they get chopped up. So you get whipsawed back and forth. You're getting chopped up, and you're giving up a lot of your gains during those periods of time because of round turn cost and whatever else. So one of the ways that you can filter those kind of trades out is using something, some sort of trend identification tool, like, DMI, ADX is a good one.
Right.
I like that a lot. The Kase trend is one that I look at as well.
Yeah, I've always thought, when building a back testing, people will want to test a signal, right? They'll go from it from an indicator point of view, and my thought was always, well, that's great until, like you said, you get into a consolidative mode, and really what you need to determine what the bias is, trend up, down, or sideways, and then figure out your signals, because you could have the same indicator but use 3 different situations for that indicator. If you think that an uptrend and a downtrend might have different results, right, for that indicator.
Absolutely. No, absolutely. 100%. I mean, in all the back testing and things that I've done over the years, and again, NinjaTrader is a platform I usually do it on because there's so much flexibility. I can test multiple bar lengths. I can test custom bars, and it's a strong language, because you've got all the power of C#. But when you do that, it's one of those things where in early testing, when I was testing like statware or trend type following systems, you basically just get chopped up to that death in those neutral states. So,
Yeah.
to me, the holy grail of a trend trading system is going to be able to identify those choppy periods early, when you're moving into it early, and then identify the breakout point, early as well. And
Right.
that's kind of the holy grail. So,
Right. We're
you
range
know,
bound until we're not, right? You
exactly.
know?
We're range bound until we're not, and it's something that we as human beings, we can kind of look at a chart and we can visualize that range pretty well and look for those breakout points. Systematically, it gets a little bit tougher to identify those on a consistent basis. Plus, as human beings, we are hindsight's always 2020. So, we can
Right.
look back and, it's very easy for us to look at and say, well, I wouldn't have traded that period, that during that time. And
Right.
yeah, well, we're ignoring those signals that popped up, and we're making exceptions to rules that we already set for ourselves. So yeah.
For sure. For sure. You mentioned programming and NinjaTrader. What I really like about your indicators is that ability to identify divergence and even, highlight it with the trend lines. I mean, that's, my experience, divergence is a very difficult thing to program for.
Yeah,
But I think C sharp programming lends itself to that. I just want to say that as an aside. Where this
100%.
this half hour always goes by way too fast, Dean. I just want to
Yeah,
let you know. But we're going to have you back on in a couple weeks, and we'll pick up the conversation because I think there's so much more
absolutely.
to it.
No,
Um,
absolutely. We could definitely get into actually looking at some trades and things like that. So,
yeah,
um, I know we kind of an introduction, but I appreciate you all. I appreciate the opportunity to come on, and yeah, I look forward to sharing more.
awesome. Where can people find you if they want to send you any questions or continue a conversation?
Yeah, the best place to find more information about all the things that Case and Company does is just our website. So Caseco, so it's K as in Kelly, ASECO.com.
Great.
And the best way to reach me is my email, dean@caseco.com. So
Oh,
DEAN@caseco.com. Yeah, feel free to shoot me any questions you have. I love talking about the markets, and I would love to share more with everyone.
awesome. Dean, thanks so much for being on NinjaTrader Live. We really appreciate it and can't wait to see you again. And say hi to Cynthia for me.
I will absolutely. We'll
All
we'll
right.
see if I can finagle and get her on here one day.
Oh, that'd be great. We'd all
Yeah,
love it.
absolutely.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.